Ever wonder how you can navigate those crazy, intense market swings without just completely sacrificing your long-term growth? Right? It's pretty much the ultimate question for investors. Welcome to this explainer, where we're going to dive deep into a genuinely fascinating case study, the Parag Parikh Flexi-cap fund. Instead of just looking at raw returns, because let's face it, that only tells part of the story, we're going to pull back the curtain. We'll analyze the exact structural and risk metrics that really make this specific fund tick.
So here is our roadmap for today. 1. What are flexi-cap funds? 2. Navigating recent market volatility. 3. Decoding the risk metrics. 4. Assessing long-term capital growth. 5. Comparing peers and benchmarks. And finally, 6. The Parag Parikh advantage.
All right, Section 1, what are flexi-cap funds?
So what is a flexi-cap mutual fund? Exactly. Basically, it's an open-ended equity fund that refuses to be boxed in. Unlike strict large-cap or small-cap funds, the managers here have the absolute freedom to invest across companies of literally any market size. What this means in practice is incredible adaptability. If the market is booming, managers might hunt for high growth in mid or small caps. But, and this is absolutely critical, when the market faces a downturn, they have the flexibility to move assets right back into more stable large-cap companies to mitigate that risk. It's like having a dynamic playbook for whatever the market throws at you.
Moving on to Section 2, Navigating Recent Market Volatility.
Now, operating at a massive institutional scale requires a really strict philosophy. Take a look at these guiding principles. We've got a long-term focus, proportionate ownership, and that absolutely crucial margin of safety. They're constantly hunting to buy securities at a discount to their true intrinsic value. And by the way, when they say long-term, they explicitly mean an investment horizon of 5 years or more. They actually anticipate low portfolio turn, meaning they buy companies fully expecting to hold them through complete market cycles, rather than, panicking over next quarter's earnings report.
So, how does this philosophy translate directly into action? Well, check out the debt and cash equivalent allocations here. Roughly 15% of the portfolio is just sitting there. But you gotta understand, this isn't dead money at all. It's a strategic buffer. Think of this allocation as a giant financial shock absorber. In fact, during that really harsh market correction between January and March of 2026, this exact structure successfully restricted the fund's maximum drawdown to just negative 10.12%, while the broader category average tumbled much, much further.
Section 3. Decoding the risk metrics.
Okay, let's break down some vital terms, starting with beta. Think of beta as a direct gauge of how wild the ride is going to be compared to the overall stock market. If a fund has a beta of exactly 1, well, it moves in lockstep with the market. A beta above 1 means a bumpier, more volatile ride, and a beta below 1 means the fund is inherently less volatile than the broader market. Simple enough, right? Next up is standard deviation. This tells us the historical range of an investment's performance. When a mutual fund has a high standard deviation, its returns are basically scattered all over the place. We're talking high highs and very low lows. A lower standard deviation, on the other hand, implies a much tighter, much more predictable range of performance. It's consistency.
And finally, alpha. This right here is the holy grail for fund managers. Alpha measures the excess return of a fund compared to what's expected given its specific risk level. So, a positive alpha demonstrates that the manager's active day-to-day decisions are effectively outperforming the market's baseline expectations. They are genuinely adding value.
Now, when we look at Parag Parikh's actual numbers, the whole strategy really snaps into focus. A beta of just 0.60, that is remarkably low for an equity fund. It means it's nearly half as volatile as the broader market. The standard deviation sits tightly at 9.93%, especially when you compare it to a category average that often pushes way past 15%. And look at that alpha, 4.07%. So the crucial point for a beginner or conservative investor is this. These metrics mathematically prove the fund is taking significantly less risk than the market, yet it's still generating positive excess returns.
Section 4. Assessing long-term capital growth.
Now, you might notice the official riskometer designates the fund as a very high-risk equity product, which, to be fair, is standard regulatory phrasing for almost any product heavily invested in stocks. But context is literally everything here. Behind that label is a fund with a phenomenal downside capture ratio of just 46%. That means if the broader market drops by 10%, this fund historically only captures about 4.6% of that fall. For conservative investors focused on complete market cycles, limiting those capital losses during the bad times is the actual mathematical secret to compounding long-term capital growth.
Section 5.
Comparing peers and benchmarks.
Let's take a look at recent short-term performance. On a one-year basis, Parag Parikh has occasionally lagged. For instance, looking at recent data, it sat at negative 1.85%, while some pretty aggressive peers like Helios and Bank of India pushed 7 to 7.5%. Why? Well, it's because of that exact cash buffer and strict value discipline we just discussed. In a highly momentum-driven, aggressive bull market, Parag Parikh's sheer refusal to chase overvalued stocks means it will sometimes underperform those high-beta peers in the short term.
But returns are only half the story. Notice the stark contrast in risk profiles between Parag Parikh and Miri Asset FlexiCap. Miri is running a moderately aggressive strategy with a beta of 0.95, so it's almost matching the market's volatility. Parag Parikh, meanwhile, is operating at a highly conservative 0.56 beta. Evaluating funds isn't just about chasing the absolute highest 12-month return. It's about asking if the fund's internal risk engine actually aligns with your personal sleep-at-night comfort level.
When you zoom out, the strategy's true power reveals itself. Using the NIFTY 500 Total Return Index as our constant benchmark anchor, let's look at the historical performance. Across 3-year, 5-year, and 10-year rolling periods, as of May 2026, the Parag Parikh's direct plan just consistently beats the baseline. We're talking average rolling returns upwards of 19%, compared to the benchmark's 14%. By fiercely protecting the downside, the long-term averages just soar.
Section 6. The Parag Parikh Advantage.
So let's pull it all together. These are the fundamental advantages we've unpacked today. You have a fund with broad sector exposure that isn't restricted by market cap. You have a highly conservative risk profile with super low volatility. There is a strict, undeniable value discipline that prevents chasing market fads, which results in that phenomenal 46% downside protection. Add in strong corporate governance and significant insider alignment, and it becomes very, very clear why this is a standout choice for conservative retail investors looking for steady wealth creation over a decade.
And the market clearly agrees. As of May 2026, the fund's assets under management hit a staggering 1.41 lakh crore rupees. That figure alone commands roughly 23.5% of the total capital deployed within the entire domestic flexi-cap category. It is a massive visual testament to the immense institutional scale and the profound trust investors have placed in this conservative strategy over its 13-year history.
Which leaves us with this final thought. When the market is roaring, it's so easy to just completely ignore risk. But true wealth is kept by surviving the downturns. Take a hard look at your own investments right now. Could your current portfolio act as a shock absorber during the next major market correction, or are you fully exposed to the drop? Understanding risk-adjusted strategies like the one we've explored today is really the first step toward building a truly resilient financial future. Keep digging, keep learning, and I'll see you in the next explainer.